All right, when you think about investing for the long haul, what's the first thing that comes to mind? For a lot of people, there's a clear default choice. But what if the data tells a slightly different story? Today, we are settling the score. VOO versus SCHD. It's a head-to-head showdown between two absolute giants in the ETF world.
So let's get right to it. Imagine this. You have 100 grand ready to invest. Where does it go? Do you chase that explosive growth with VOO, or do you opt for that steady, reliable stream of dividends from SCHD? This is the exact choice we're breaking down today, using real data to find a clear answer. So let's meet our first contender. First up in the ring, we've got the heavyweight champion, the undisputed titan of the market, VOO. For so many investors, this is the go-to, the automatic choice for investing in the U.S. stock market, and honestly, for a lot of very good reasons. So what exactly is VOO? Well, think of the S&P 500 index as the main pulse of the entire U.S. economy. It tracks the 500 biggest American companies. VOO's job is super simple but incredibly powerful. It just buys and holds all 500 of those companies to perfectly match the index. Nobody's in there trying to be a genius and pick winners. It's all about capturing the growth of the entire market.
And here's one of its biggest selling points. VOO is ridiculously cheap. Its expense ratio is just 0.03%. That's practically free. It means almost every penny of your money is actually working for you, not getting eaten up by fees. And with over $1 trillion in assets, you know you're investing in a fund that is massive and trusted by millions.
Now, if you pop the hood on VOO, you really see what makes it tick. As of mid-2025, a whopping 30% of the entire fund is parked in information technology. You have to understand, this heavy bet on tech has been the primary engine, the rocket fuel, behind its incredible performance over the last decade.
And that massive tech weighting? Well, it's no surprise when you see the top holdings. We're talking about the biggest names in the game: Apple, Microsoft, Nvidia. So when you buy a share of VOO, you're not just buying the market, you're making a significant bet on the continued dominance of these absolute titans of technology. All right, let's shift gears and bring in our second contender. This is SCHD, the dividend dynamo. And let me tell you, it plays a completely different game than VOO. It's all about that income. See, unlike VOO, which just buys everything, SCHD is way more selective. It's laser-focused. Its entire goal is to hunt down 100 of the highest quality U.S. companies that not only pay dividends, but have a long, proven track record of doing so. It's not about hype, it's about financial strength and consistent payouts to its investors. So how does it find these gems? Well, it runs every company through this really tough 5-step quality check. First, you need at least 10 straight years of paying dividends, no exceptions. Then it dives deep into the financials, looking for strong cash flow, low debt, and high return on equity. This whole process is designed to weed out what we call yield traps. You know, those companies that offer a juicy dividend but are actually a financial mess waiting to collapse. Now, looking at its stats, SCHD is also incredibly efficient. Yeah, at 0.06%, the expense ratio is technically double VOO's, but let's be real, that is still extremely low, especially for a fund that's doing all this extra homework with its screening process. And it's no small fry either, managing a hefty $68 billion. Okay, now just look at the sector breakdown compared to VOO. It is a night and day difference. SCHD is all about those classic defensive sectors. Think consumer staples and energy. And information technology, it's a much smaller slice of the pie here, making up less than 9% of the fund. And that strategy is perfectly reflected in its top holdings. You see these steady household names like Coca-Cola, Verizon, and Cisco. These are the kinds of companies known for being reliable and for consistently mailing out those dividend checks, not necessarily for explosive, headline-grabbing growth. Okay, we've met the contenders. We know their strategies. We know their game plans. Now for the main event. It's time to stop talking theory and start looking at the cold, hard numbers. Let's see what more than a decade of real-world data tells us about who really comes out on top. So this table shows us the compound annual growth rate, or CAGR. Basically, it's the average yearly return you would have gotten if you reinvested all your dividends. And, well, the numbers speak for themselves. Across every single time frame, 5 years, 10 years, and since SCHD was created, VO has consistently posted a higher growth rate. That's the power of that big tech-fueled bull run we've seen. But percentages are one thing. What does this mean for your actual wallet? Let's run a little experiment.
Imagine you traveled back to October of 2011. You put $100,000 into VOO and another $100,000 into SCHD. You don't touch it, you just let it ride and reinvest every single dividend for almost 14 years. What would have happened? First up, VOO. That initial $100,000, it would have ballooned into an incredible $635,000. That is a total return of 535%. Just wow. Now for SCHD, that same 100 grand investment, it would have grown to a very impressive $485,000. That's a 385% total return, a fantastic result by any measure, but clearly a different outcome.
And seeing it on a chart like this really puts that difference into perspective, doesn't it? Over this specific period, VOO's final portfolio value was significantly higher. Even with all of SCHD's wonderful dividends being poured back in, the raw power of capital appreciation, the simple act of stocks going up in value, in VOO's growth-heavy portfolio was just too much to overcome.
And this quote just perfectly sums up everything the data is telling us. This is the classic age-old trade-off in investing, right? Do you want the potential for higher total growth, or do you want higher current income and stability? There's no single right answer. It all depends on what you're trying to achieve. So, after breaking it all down, what's the verdict? Who won the showdown? Well, here's the most important part. The best ETF isn't about which one had the highest number in the past. It's about which one is the right tool for your specific job, for your goals, and for where you are in your life. Think of it this way. If your main focus is on long-term growth, you have plenty of time, and your goal is to maximize your total net worth, VOO is probably your champion. You can handle the ups and downs of the market. But if you're getting closer to retirement and your focus shifts to generating a reliable income stream with maybe a little less drama, that's where SCHD really starts to shine. So, what's the big takeaway from all this? If we have to make a call based on the historical data, it's pretty clear. For most people who are building wealth for the long term, VOO has proven to be the superior choice as the core of a portfolio. It's a powerful, diversified engine for growth. But I want to leave you with one last idea. The entire debate is always framed as VOO or SCHD.